I'd like to introduce today's program coordinator, Marianna Hunnicutt. Marianna is a licensed civil engineer and practice builder with Kimley-Horn and Associates, specializing in private sector land development in Southern Nevada. Marianna brings 8 years of commercial development experience in retail, industrial, mixed use, military, sports venues, and gaming development. In NAIOP, she's been instrumental in our programs, so I'd like to thank she and her employer for their support of our chapter. On that note, I'll hand it over to you, Marianna.
Thank you, Dave. Good morning and Happy New Year, fellow members. Despite the twists and turns and many unknowns from this past year, the Programs Committee has remained steadfast and adaptive in our commitment to stay relevant and engaged and keep you all informed during these unique circumstances. In that vein, the committee decided to change things up a bit for our annual kickoff event. Many of you are accustomed to attending the forecast event at this time of year. Well, we figured, considering the circumstances, who better to share insight into that arena than active developers in the Southern Nevada market? And with that, we decided a developer roundtable was the most sensible approach for this program. But you may ask, how do you create a roundtable feel in a virtual format? Well, we decided to get a little creative and change things up as for the virtual format as well. We invited today's speakers, Rod Martin with Majestic Realty Company, Jeff LaPour with LaPour, John Ramous with Dermody Properties, Reed Gottesman with Harsch Investment Properties, and Jim Stuart with Matter Real Estate Group, all active developers in Southern Nevada, to get together for a recorded virtual happy hour with no particular agenda, no moderator, free reign, and only a few ground rules. Now, we did provide an outline with some potential talking points in case we needed to help spark some conversation. But come on, we should have known better. They didn't even touch any of the provided topics, and instead, in true fashion, never ceased to amaze. During the upcoming video presentation, please feel free to use the Q&A function at the bottom of your screen and input any questions you have for the speakers. Following the presentation, they will be here live to answer those questions. I will also be back with the great Mike Shohet, our sponsor for today, to help facilitate the Q&A session at the end. It has been a great privilege to coordinate this event with these gentlemen. I hope you enjoy the program.
I actually thought that this was being moderated a bit to kind of spark the conversation. I must have missed that.
I guess let's try to spark our own conversation.
I don't think you need to worry about hurting anybody's feelings. If you want to tell me that my product is crap, go right ahead.
Rod, nobody needs to tell you that. It's kind of universally known.
You do all the time, Jim.
Yeah.
Hey, a good-looking building's a full building, right?
That's exactly right. Who needs any awards? Cash flow.
Curious how the restaurant business is, Mr. LaPour.
Believe it or not, the restaurants that I'm involved in are doing some of the best they've ever done. There were periods of time in the last 10 years that I thought, oh man, this is it. This is it. We're finally kind of getting to the point where, all these new openings have, diluted everybody. And then when the pandemic came, and I guess because it's a casual, family, deliverable product, sales have gone up quite a bit. And it doesn't seem to matter whether there's a 25% restriction on indoor dining, a 50% restriction, because takeout and delivery is so strong. It's been good.
It's fine, and expect this conversation to go towards restaurants, but we have this chunk of Chinatown we own, and we brought up pandemic at the beginning of this. Nothing was affected as quickly as Chinatown, but since then it's actually doing really well. We're working on 3 or 4 new restaurants. We're going to invest another $1.5 million into the center to do some really cool design work on the west side of the center. And we've actually never been so occupied on the Spring Mountain restaurant side. So go figure. So why are you so much more active in Arizona? Or is that even an accurate statement? Are you more active in Arizona?
Yeah, I mean, it's because I can get scale there, and I can get scale quickly. You know, it's just a bigger market. It's actually easier to transact there. And I think it comes down to land ownership, really. Phoenix is equipped to grow forever, kind of in our lifetime anyway, whereas Nevada really is, it's more of a California environment where every single parcel is an infill, and it's difficult. I mean, it's great to get the sites. It's great to do the work here because the rents are high, land costs are high, construction costs are high. But demand is good because the market's so constricted. There, it's good because there's lots of opportunity for growth.
I think the issue there has always been more the rent growth, right, or the lack thereof.
John, that's true, very true. And it was I first went to Phoenix 20 years ago, but it was always build it at an 11 cap, sell it at an 11 cap. And then about 2001, it shrunk right down to a 6 or a 7 cap. And then it's continued to go. I think most markets around the country are the same now. Now you might get your California guys are getting 3 and 3.5 caps, and we're getting a 4.5 cap here. There might be that kind of delta, but most every market is it's in lockstep almost. I mean, the yields aren't that different in terms of what exits look like, at least from my experience.
Jeff, to John's point, there hadn't been a lot of rent growth in Phoenix over the last couple of decades.
No.
You're finally starting to see that a little bit now over the last, year and a half, 2 years?
That's right. And, the lack, here's the weird thing, Rod, is that the lack of rent growth there hasn't kept, institutional capital has been there for 25, 30 years, right? Yep. When did we get institutional capital in any meaningful way? 10 years ago? I mean, Prologis came up here and did a couple one-offs, but I'm talking about in a major way.
Yeah,
no, you're
5
right.
years ago.
Yeah. I'm in Denver too. And Denver is basically like the Orange County of the Midwest. But Denver is the only place that I know of that has higher construction costs, equal to or higher than Nevada for sure, and it may be tied with California. It's incredibly expensive to build there. I found it's easier to sell Southern California money on Las Vegas and Denver than it is, Phoenix is much easier today, and it's much more popular than it ever was, but California capital identifies with the fundamentals in Nevada and Colorado really well. They're all high priced, high barrier markets.
Hey, Jeff, is it easier to get into Denver than it is, looking at deals in Southern Nevada?
It's easier to buy larger parcels, but it's still difficult. So you'd fight like hell to buy a 10-acre site here. You can fight like hell to buy a 20 or 25-acre site there. But they all have hair on them, John. I mean, everything, I think everybody in this room would agree that there's issues to be solved on every single deal that you buy. I mean, in Nevada. I mean, I'm watching Jim's project at Uncommons, and I mean, there's a lot of grading, utilities. I mean, it's everywhere. You're never buying finished sites. In Phoenix, you can buy a finished site. Curb, gutter, street light, sidewalk, it's ready to go. You're not putting in, 3,000 feet of streets, and they're zoned and ready. So you're not tied up in a 1.5 year entitlement either, in fear of missing the cycle.
And Jim, I'm sure can attest to this. I mean, a lot of people don't recognize, the complications that causes not having, the utilities and the entitlements and so forth that we all, suffer through literally on every project that we do, that we need to go out, to acquire the entitlement work. And even when you think you're done, you're not, and you're continually going back, throughout the permitting process. And it's not easy developing here in particularly Clark County, but throughout the Las Vegas Valley.
Yeah.
I passed by Uncommons a couple weeks ago and traveling up north, and things are moving along. How has the plan changed with the pandemic?
We're going all industrial.
Yeah.
Perfect.
Live, work, apartments on top.
Yeah, just putting docks on the back of office buildings, and it's fantastic.
Yeah.
But ironically though, our land basis there, and what has transpired in that town over the last 12 months, I actually could have been just fine doing industrial. So we're in that dirt at $18 a foot. Now looking back, we probably would have had a lot of optionality just to sell dirt. That's not what anyone in this call wants to do anyways. We started construction on that project over the summer. So when the pandemic first hit, there was more nights than I care to admit with a tall triple pour. So exactly. Yeah. I'm now on dry January at the request of my wife.
I'm gonna join you, John.
Yeah.
Right.
So it was a tough move, and I think that the only thing that pushed us forward was a steeled determination to bring something that I believe in my heart that Las Vegas sorely needs, that the market sorely needs, and that is a modern mixed use workplace experience, and something that we could all point to and let that town stand shoulder to shoulder with any of the projects that have been built around the country. Thankfully, having a group like Gensler, this is not simply our wisdom that hit the paper here. This is having some brilliant people out of California, a bunch of designers and local consultants in Las Vegas. And look, time will tell. But we and our team just really, I couldn't be prouder of the people that I've been working with, because they took on a very complicated project, wrapped it around a pandemic, got stuck with civil unrest, election controversies, and everything that you could possibly throw in. We've been keeping a log of every single obstacle that we've had to overcome along the way, and it's been. It's every day we've tightened up our shoes, get in there and say, what's what's coming our way today? Now, as it kind of relates to probably what anyone on this call or the audience would care about is, well, okay, great. So you guys worked hard. Does that mean anything anymore? And I would say I have, from the onset, when this thing was first coming out of ground pre-pandemic, or not coming out of ground, but first working pre-pandemic, and much like Jeff, who was next door with me, at Narrative, I was, you would expect, recipients of all kinds of inquiry, inbound leases. Things had great momentum. I probably could have leased the first phase 3 times over. Restaurants lining up. I mean, everything we would have hoped for, to kind of create that excitement. Then we got punched in the face, and had to kind of recalibrate around what does COVID mean? What does it mean to the built environment? I watched the same headlines. About we're going to work in our pajamas for the rest of our life, which I found to be nonsensical, to begin with.
Totally.
It made no sense.
Yeah.
Yeah. I was like, really? Okay. So you may be able to maintain your operation like that, but you aren't going to innovate and grow. And
you might not even maintain it, Jim. I mean,
you may not. Yeah. Depending upon where you are.
Just look at this call. Look who's in the, most folks on this call are in their offices.
Yeah.
Appears to be.
Only one of us is a hypocrite on that. To Reed's comment around what's happening on Spring Mountain and Jeff in the restaurant business, it's the tale again of 2 tapes. There's a lot of restaurateurs that were paralyzed and frankly going to go out of business. I've had some of the more sophisticated and the more recognizable chefs that have been coming off the Las Vegas Boulevard and trying to get into the suburbs, and those chefs have been, and those restaurant operators have looked me square in the eye and said, we are going to be more aggressive than we have ever been in the history of our business in finding new locations. They've learned, new ways to innovate. They've found new ways to generate revenue. They understand the importance of out of restaurant delivery, walk-up windows, curbside pickup, outside dining. I mean, the models for those that really have leaned into it are becoming crystal clear.
And it can actually be more profitable, Jim. I mean,
exactly.
We're finding that to be like, there was this big theory about restaurants, how it has to be. And I'm sure the experience component will be back, like everything will be back. But this particular piece of the business, and you see it with the guy from Uber, these ghost kitchens and whatnot, they've figured out that people are happy to take the food with them. I mean, granted, people want human contact, they want social components, all that. But in the absence of that, sales have never been better for some of these guys. They know how to do it with less overhead, just like we figured it out after 2009. I mean,
Hey, the elephant in the room would be is, with narrative and uncommons, I don't keep track really of the office, requirements these days, but are you seeing, some pretty competitive environments, or is there a pretty distinction between the availabilities within your office spaces there?
Well, I don't know if it's an elephant in the room. I would say that there's more room than needed for a narrative, for non-comments, and for B, C, and D. Look, up front, I think as competitors would be, we're going to wrestle over any tenants in the market and try and outflank the other. However, for us, we consider it to be net positive long-term to that area, to see Jeff's project, to see 2 or 3 others. And frankly, everybody wants to be along that beltway. It's the right location. So I think there's more food on the table than we could possibly serve up.
I think that's true. And I think one thing I learned from the last office building that I delivered, unfortunately, in 2008, is that, there's lots of talk about office buildings that are 2nd, 3rd, 4th row from the freeway. And I think what matters, particularly in Las Vegas, there's this
dogtail my back here.
There's this want to be like super visible, and like I know if you looked at what everybody who said they were going to go, there are a handful. There's us, there's Sansom, there's Jim, but there's a lot of them that out there that aren't really freeway visible, and I think there's a huge distinction in this market over other markets, particularly that, when somebody is going to make a choice, they're going to have the desire to make the best choice. So like if you're off into the Bend or whatever, some of these other facilities, all great buildings, all great developers, that's going to be like a tier 2 choice, I think.
100%. Yeah, couldn't agree more.
Tech Center as well, UNLV Tech Center as well. So I think, and we're not talking about large lots of space here, guys. I mean, in the grand scheme of things, I have 100,000 feet. I haven't seen Jim's first phase, but I think it's 100 for office. We're not talking about somebody adding 400, 500, 600,000 feet in one shot here. I mean, these are bite-sized pieces. And if you really net down the pre-leasing we have versus what's left, we've got like 60,000 feet left. So it's important to hit on that distinction that, we're not talking about this massive overhang of office space.
So I think there's 2 things I would touch on with and then I'll retreat again here that Jeff said. So this is kind of just a real-time data on tenant behavior and the importance of that freeway frontage. So we have a international brand that everybody would say I know it coming out of Hughes Center. So I think that Hughes Center really should be part of the story, not whether Jeff and I are going to wrestle over Hughes Center is going to be the piece that people should be talking about. But in this case, this is a brand that so we have 150,000 feet in our first phase. The buildings, one has a 20,000 foot plate that's up against the freeway, and a 25,000 foot plate that is our building 1, which is more internal and off the freeway. Had I known now what I known then, I would not have put one internal. This tenant, who fits perfectly in 25,000 feet, has opted instead to split a floor to be on the freeway.
Yeah.
Now I can't imagine the inefficiency of being on 2 floors, but they said, we need to have a brand on the 215, period, paragraph. That's how important it was to them.
Yeah. And if you look at like like if you're going to be in an office building in Las Vegas, I would venture to say that you're going to be between I-15 and 215 and downtown Summerlin. I don't see a lot of office being built, or really any for that
Outside of there, yeah.
outside of that corridor. So like I tried to buy St. Rose and I-15 right across from the front's the freeway. And I tried. And the thought was we were going to do like a McCarran Center type deal, some industrial, some office. So we couldn't get a deal done, and it turned into housing. The entire thing, freeway front, is housing, 100 acres of it. Now, they might be holding off some on Las Vegas Boulevard frontage, but to me, that's not really a housing site, but I guess there's so much demand for housing that it is a housing site. That was one of the only locations I thought that could, in the path of travel, kind of for the future, compete with the 215.
Yeah.
And that happens over and over and over because our city allows the highest paying use to change the zoning. It doesn't protect these pods. So if you look at 215, it's almost like beachfront. How much is left if anybody did an inventory? Is there 900 feet of frontage left in 3 different parcels? That's probably it.
And I think that speaks to Jim's comment about $18 a square foot, which, a year and a half ago, people, myself included, thought he overpaid for it.
Yeah.
Today, you see 25.
You didn't tell me that.
Well, you're seeing 25
You've
bucks,
always been
30
bullish.
bucks, $35 a foot for frontage on the South Beltway.
Yeah.
Sure.
Rod's the smartest guy in the deal here with the airport land lease. I mean, and I did hear something recently that could keep you busy for much longer. But man, I mean, how happy are you that you guys locked all that stuff up, 15 years ago?
Ecstatic over it, Jeff.
You have to be.
And, it's funny, and just to share with you kind of the history to that, as I'm sure each of you would say, oftentimes you just kind of stumble into these deals.
Sure.
There's no genius behind it. It truly was the result of a problem that we had on another project that in turn, amounted to a tremendous opportunity. Then, fortunately, we were able to, see the opportunity and then in turn seize upon it. But so much of the time, what we wind up with it and, what appears to be simple deals and deals that, otherwise may not have been visible to everybody, you oftentimes do just stumble into those deals. And obviously relationships, are very important to have, but
sure.
Oftentimes, sometimes the biggest problems turn into the best opportunities for you.
What do you have left down there now at the Beltway? Are you between Switch finishing up there? What's left?
So, Switch just has a voracious appetite and continues to take on more and more land. Not only that, which they're ground leasing from us, but also the land they acquired west of Jones continues, their data center business is, growing off the charts and, continuing to, again, take as much land as will allot to them. At the same time, that is counterbalanced by our desire to continue to construct more warehouse facilities. For the time being, despite Jim and Jeff's comments, we're still going to pass on additional office product, particularly on a spec basis, and we'll just concentrate on what the hot product is in the marketplace, and that's more warehouse space. So to answer your question, Jeff, John, we've got 2 buildings under construction presently that we're targeting for completion June-ish of this year, June, July, and thus far seeing tremendous opportunity as we all are on industrial. At the conclusion of those 2 buildings, which, right now there's enough activity to give us reasonable reason to believe that we'll actually have some pre-leasing activity and potentially 2 full building users for those 2 buildings, which of course isn't what you designed, but at the same time, it's nothing you're going to, turn away from. So the activity level still in the Southwest submarket for industrial is strong. We've got 2 more areas in which we'll develop after that. One will be another 3 building project, and the second area, another 2 building projects. So we've got enough for the near term out there on the Beltway project.
Nice to hear.
So Rod, do you have product, Jeff mentioned product on the shelf. Do you have product available on the shelf, or are you pretty much out of product and that's why you decided to spec some of these buildings?
So when you say product available, you mean land holdings?
I mean available space for tenants.
So, as we sit today, we have just 2 units that are available. standing inventory. So, which amount to, less than a 1% vacancy in the portfolio, which, to me, I'm pleasantly surprised that that's all that we've suffered from with, what has been undoubtedly devastating to the resort corridor industries, particularly the trade show and convention business. But, fortunately, it's, been augmented by the continuing strength that we're seeing in e-commerce and logistics. And surprisingly, seeing a lot of those users coming into this submarket, which historically they've shied away from and, gone up to the North Las Vegas and West Henderson markets. So, and I think it's a little bit of a function of available supply, but at the same time, for the same reason that Jeff and Jim feel as strongly as they do on the office market, it is the location. And it's, the proximity to the I-15, to the resort corridor, and to our residential bases, not only for between Summerlin and Henderson, but also we see good entry-level housing elsewhere in the Southwest.
So Rod, you are the most focused product guy over the longest period of time.
Most unimaginative, are you saying?
No.
Boring.
No, I really want to know the answer to this question because I'm curious, because I have this discussion and debate constantly. So let's go all the way back to the Berkshire land that you bought.
When you're working with Dean at IPG?
Yes, way back. When I had dark hair.
Okay, we're going to stop you right there, Jeff. I'm speaking on behalf of Rod, John, and I. If you or Reed make any comment about your hair, we're going to have a sidebar.
I was going to compliment you on your hair today, Jim. I think it's looking good.
Yeah, you're looking good.
I'm hanging in there.
So from the day you built your first building in Las Vegas to your deal on Decatur on the east side of the road, walk me through your clear height selection.
So,
and the evolution of from what to what.
So the first project we did, as you mentioned, on Berkshire Drive, which very few people that are listening to this know where the hell Berkshire Drive is. Yep. Essentially, it's at Valley View and midway between Sunset and Russell.
Yep.
And the interesting thing, Jeff, and you remember at the time where you really couldn't get there from anywhere in the city. It was just you would have to go around the railroad tracks on what used to be industrial, today Dean Martin. And we, as a company coming out of California, honestly thought we were pioneering in an outlying area of Las Vegas. And you have to say, what the hell are you talking about? Couldn't you look at an aerial? You're not pioneering anything. You're a mile away from, what at the time was, Excalibur that was just, and the Mandalay Bay that was, at least on the drawing board. But nevertheless, that was, an outlier from the standpoint of industrial. There wasn't a lot of industrial in Las Vegas in 1994.
No.
And we came out there and we wound up doing the first two buildings at 26-foot clear, neither of which were ESFR. At that point in time, ESFR was commonly accepted, but on smaller buildings like that, it wasn't deemed necessary. And we had pretty strong static pressure to get the sprinkler system, higher density sprinkler system in those buildings. So those were 26-foot clear.
Yep.
We then moved over to the Russell Road project, which is Russell at the railroad crossing, again, just west of Valley View. We went with 30-foot clear buildings. The interesting thing there is we still had a California developer's mindset and didn't really design those as multi-tenant divisible to plus or minus 25,000 square foot units. And if you were to go by the building today, you can kind of see some bastardized entries that were afterthoughts. But we went into the 30-foot clear buildings and really for the, got a good understanding of what this market was at that time. We didn't need to go 30-foot clear in that building. And quite frankly, on a go-forward basis from there, we went to 28-foot clear in this submarket. Everything, say, from 97, the projects at Sunset and Valley View, all the way up to 2008. And for us, it wasn't until the building we built in 2015 that was 32-foot clear. Now, the interesting thing, and going back to the comment, I forget if it was Reed or Jim who said this, is that that would seem to be antiquated. And it may not check all the boxes for institutional buyers, but as we all know, we're not sellers. And as we look at the marketplace, quite frankly, in the Southwest submarket, I would say maybe 1 out of every 10 tenant even uses a 28-foot clear building. It's starting to increase now. But when you're looking at the smaller divisibilities, as as you all know, it's really not the same priority that we're seeing up in the big boxes. Those uses, obviously, Amazon takes a lot, and the Walmarts of the world and the rest of that. But particularly in the submarket that we're in, it's probably a little bit overkill still today. But if you're going to hold the buildings long term, I think you'd rather have the clear height in anticipation that they're going to hold up well into the future.
I would agree. I built 340,000 feet in 3 buildings in Southwest Denver, and divisible to 30, give or take. One, we had a cross dock in the middle that was about 170,000 feet. It was like 300 across. And the costs in Denver are so expensive that we made the cross dock at 32, and we made the 2 front park rear loads that are like less than 200 deep. We made them 24. Mm-hmm. And we just sold it to LaSalle. And there was never not one problem, never not one discussion about how and why the 24 in those 2 particular buildings could be a problem. And I have this conversation with brokers in every market, and they are insistent. 28, 32, 36. I'm like, guys, this is an elevator shaft. I mean, the buildings don't need to be
going the extra 4 feet. It's going to cost you $2.50 a foot. Are you going to get that in rent? No, you're not.
No.
So let me get it. Guys, you're going to have all the boxes checked.
This building right here, it's under construction. The sweet spot here is 15,000 to say 40,000 feet, and the north half is 28 clear, south half is 32 clear. So I mean, we're on the below the spine is a different clear height, and it's 28 to 32 feet. So we're in the same boat.
Reed, it's interesting you mentioned that, because when I saw that flyer come across from JLL, I had to send an email over to the guys at JLL and ask them what the hell is going on.
What are you thinking?
On one side of the girder 28 and the other side 32. And I said, is there a step in the building? And, thinking that was a ridiculous question to ask, and lo and behold, there is.
So it's construction costs. And so we won't do a cross dock in that building. That's all. The spine will go up and it'll stay that way.
Mm-hmm. But it's a recognition.
We tend to spec each unit anyway, so it doesn't negatively affect us.
And I think that makes perfect sense. It's one of those things at first you say you're going to bypass a cross dock user until you take the time to really think it through, and you know exactly who you are and what you do and what the market is, and you're going to go ahead and fill those individual units. And there's plenty of big boxes up there that can accommodate the cross dock users, and that's just not who you are. That's not what this building is.
That's not the game we're trying to compete in.
For those of us that are out trying to constantly feed the system with new supply in Southern Nevada, I don't know how it's been for any of you guys of late, but I will tell you, I feel like I'm picking over, dead carcasses of sites that are, I can't get my head around the price. The site has all kinds of issues with it. I will tell you, we made an offer on a property in West Henderson, keeping in mind that when we bought our first piece out there, back in the, whenever that was next to Raiders at $12, that's when I thought I overpaid, Rod, by the way. Just last week, we made an offer at $18, and the seller said, I'm not even going to respond to you. You're not even close. And so we're scrambling around, and now we're looking at a piece. Our West Cheyenne project is going to be stable in another quarter or two. We're trying to replace that with other product. People are throwing stuff at me, 15, 16, 17, $18 with hair on it. Nothing in North Las Vegas. I mean, to me, the real issue coming down for Las Vegas is not one of unbridled optimism around real estate, or industrial specifically. But where's the supply going to come from?
Well,
it really is.
And Jim, I think expanding on that is not what the land price is. How do we, Southern Nevada, and I've seen this over the last year, in coming to Reno, I saw the kind of eye-opening that, the diversification that Northern Nevada has and was able to successfully, recover from during the last recession. And unfortunately, the concern is without that, available land at reasonable prices for that diversification, how is Southern Nevada going to be able to get out of this situation, knowing that, obviously the BLM, the land play is obviously the holy grail, and releasing that sooner rather than later and moving through that. But that's not going to happen within the next 12, 24, 36 months.
Not at all.
Rod, Rod and Jeff and many of us have been dealing with this for 20, 25 years and going back to DC. But how do you, unfortunately, it's a tale of two cities with Southern Nevada, because you have a continual gaming tourism, which is great when it's on, but how are you going to track some of these businesses? I mean, I just, as recently as yesterday, had a million square foot requirement being discussed, and they said, I can't accommodate that. And speaking of West Henderson, I do have a site. We closed on that site, just closed on it, and we'll amass about 65 acres at the end of the day. But outside of that, infill, what other options are there for a large user that wants to knock on the door? And the comment was as well, we're just going to look at Phoenix, or we're just going to look at that other market.
That was my point, is that the problem in Nevada is twofold. And we have a scarcity of land. There's no question about that. That's always been the case since I've lived here for 30 years. The bigger problem is that the municipalities will allow, and I'm being a little sarcastic, but not much, any zone change anywhere at any time.
Yeah.
So the product type that pays the most, industrial was always last in line, wins the day.
Well, in many ways, Jeff, it's too late. There was not a comprehensive plan. Well, there was a comprehensive plan, but not one that was actually mandated. And once the entitlements, you're right, highest bidder wins. And it's there's no end in sight. That also will be the same thing with BLM. That's going to be highest bidder by mandate, and that's going to be a home builder.
Yep.
So I think there's two things that that NAIOP should be paying attention to. And Rod, I think there's a question around the NAIOP land study, which I'm not familiar with. So there's two things that I'm concerned, and I think it was John who brought up this diversification of Southern Nevada. So in order to bring that more dynamic employment base, the people that it's overstated, the companies leaving California, by the way, but there's enough to make a true impact in a place like Southern Nevada. Where's the space? And now you look at the office, and Jeff, all too well, the market is very strange in the sense that, office has to be built in that market like industrial, spec.
Sure.
I will tell you, there aren't many lenders, and I went to, across the country trying to get lenders on Uncommons, and I constantly told them, I get it, but no one is going to pre-lease office space in Nevada, no matter, if you have a reputation or not. They need to see buildings. It's just a very skeptical market. I'm not being critical of the brokers. I know there's been a lot of things that have been promoted and never built, so they're gun shy, but it becomes an impossible standoff. So you have to put up spec office, and there's no real estate to do it. That is going to, by itself, greatly challenge the ability for Southern Nevada to diversify its economy, period. Now you flip that over to the industrial, the supply is going away. Southern Nevada, and I see the headlines in the RJ and everything else about how great the real estate market is. They always point to housing and industrial. So, what is the town going to become? Like Inland Empire? I mean, is it going to become, Palm Springs, where it's a snowbird housing market, and with a tourist corridor? I mean, I don't know what the long-term plan is to create a truly vibrant, diversified economy in Southern Nevada. I have family in Reno. It's a completely different story out there.
Yeah.
They're doing a great job with it. And I have another, since now I'm on I'm going to get shot somewhere, for being overly critical, but I'll tell you, I'm also amazed that there is not a cohesive plan between the jurisdictions in Southern Nevada and LVGEA to pool up as much of their resources as they can and get out to California with a unified, consistent, provocative message to move into Southern Nevada with your business. They're going everywhere and jumping right. We are now a flyover city because they're going to Phoenix, they're going to Boise, they're going to Salt Lake, they're going to Provo. I mean, come on, it's just, it's just an amazing opportunity. I think is just getting wasted, through this entire experience right now.
Well, if you look, Jim, let's just look at all the office buildings of any significance that were ever built in Southern Nevada. Show me one that was done with institutional capital, because I can't think of any.
Right.
And that includes Hughes when they were a private company. They built Hughes Center when they were private, way before Rouse, way before GGP, way before who they are today. Then you hop out Thomas and Mack, family company, right? You hop out EJM, family company. You hop out to what you've done and I've done, all private syndications.
Yep.
There has not, to my knowledge, been one institutionally financed or backed. Now, I could be wrong. There may be one out there.
No, I can't think of one either.
Greenspun's
built all their own.
No,
I mean,
yep.
it just in 2020, in a market like this, isn't that shocking?
Rod, you gotta head out. Hopefully going forward as well.
Cool. So we've got a bunch of questions for you guys. I thought I'd kick it off. So if nothing else, NAIOP is typically very timely. So there was an article in this morning's RJ. I'm not sure if you guys saw it, but I'm going to read you the headline. It says, Las Vegas office space leasing may rise in second half of 2021. I think that speaks exactly to what I think Jeff and Jim were talking about, and they both seem to be bullish on the office market. Obviously, they both have projects that are coming out of the ground, Class A office or mixed use. We've got other projects in the Valley, the Village at St. Rose, which is close to 300,000 square foot of mixed use. Howard Hughes just announced another building in downtown Summerlin, a 10-story office building. And we've got, Roland Sansone's Axiom building on the 215. So there's quite a bit of product coming out of the ground. Jim mentioned, he said, his quote was, "There's more food on the table than we can serve up." So he thinks that there's more tenant requirements over the next short term to easily fill the space that's in the pipeline. So my starter question is, where are the tenants coming from? Is it organic growth in the market? Is it transplants from older, more functionally obsolete buildings? Or is it new tenants coming into the market? And I see Jeff is on mute, and Jim's with us now.
Yep. Yeah. I'll take first shot, and then Jeff can make it sound right. So, I think it's all the above, Mike. It's, the story is, in many ways, it's just a preference choice of being on the Southwest Beltway. So, I'm not suggesting, nor do I think Jeff is, that there's a net positive growth to the overall occupancy of Las Vegas. I think the story will play out that, properties that have modern amenities, well located, have perhaps a health and safety story to them as well. But new space is still going to be in demand. And when you look at the scale of what is being delivered between, ourselves or Hughes and everyone collectively, it's 1.5%, 2% of the overall inventory of the market. So I just frankly think it's just not a lot of space. And the tenants that we're, working with are coming from out of market, in market, relocations out of Hughes Center, relocations to the Beltway, relocation to larger footprints. So it's a combination of a lot of things.
Jeff, anything to add there? Are you seeing anything different?
No, I think there's a changing face of tenants coming to the market. There's good demand. We're getting good traffic. I think I feel the same.
I actually have a follow-up question to that. It was a question from one of our audience members. Arguably office space has been readily available throughout Las Vegas for decades. And do we see new companies coming in to take this space, or are we moving away, from other places of town, places like, Flamingo, Sahara, or even the Hughes Center, what happens to those areas, those office spaces?
Not trying to accommodate too much time here, but I'll say from our perspective, at least as it probably relates to the Class A Beltway locations, most of the tenants are a flight out of Hughes Center, and I think that will be an ongoing flow that I'm sure others are trying to figure out how to stem, but the need to get out of the core center of town and into a more modern building or perhaps a more convenient location on the Beltway is what's driving the work, at least for me, I'm sure with Jeff and anyone along that Beltway. So
what do you guys think happens to that older functional, quote unquote, functionally obsolete space? I mean, how do we redevelop East Sahara, East Flamingo?
You're seeing it now. You're seeing things at Hughes Center that a year, 2, 3 years ago was out of the question. I think somebody had told me it might have been Mike Tabik, or Tabor, but there's 4 or 5 call center deals that have been done there now recently. That typically indicates almost low cost provider type mentality. And I think you're going to continue to see that to the extent that can be backfilled. I think it was the perfect storm for Hughes Center. It was a great asset that just the city changed.
Hey, Mike, I think you also, it may not be the next 2 to 3 years, but, this gets back to what we talked about, as a group earlier. That's, where do we want to be as a community? Is it redevelopment for the university? That's such a ripe opportunity for, some of the tech programs, engineering programs. So you have to tap into some of those opportunities where other cities have been successful in revitalizing some of those older areas. I think you're going to certainly see that Southwest and the West Side take advantage of that demand. But I think what's going to ultimately happen is 3 to 5 years, you're going to continue to see that those repositioning of those assets because of the value opportunity there.
Great. So let's switch to new office products. So I heard during the discussion several times about how difficult it is to develop in Southern Nevada. Land availability, land prices, access to capital. All of those are factors that are driving project costs up, and that has to transition or become increased rents. How much can the market sustain? I mean, how high can rents go and still, attract tenants?
Well, I think, Mike, that the flaw in the question, I don't mean it to structure as such, but is that we can't categorize all space into a singular homogeneous bucket of it's all office space. Different users are going to pay premiums for different attributes that are strategic to their company. The cachet of a 215 building sign, the enhancement to worker productivity by being in open floor plates and modern buildings. People that want to be in a dynamic mixed use because they think it's important to their recruitment and retention and getting the best out of their employees. And there's other categories of office users that really are economically driven, and they have less of a function around innovation and productivity, and more around a more task-oriented business. So it's very difficult to lump it all in. The one thing we reference regularly, so our rates at Uncommons, we're at 325, and we'll probably push that if we can, modified gross, but so 350 equivalent. You look at Hughes Center, pre-financial crisis, so 15 years ago, their top rack rate ended up at $4 plus. So I think the market's been somewhat conditioned to think these are low rates are sustainable, and they won't. There'll be pressure on modern buildings, Jeff's and others, to push rates up because it's expensive.
For sure. And I think the one thing that markets like Las Vegas have, where there hasn't been new construction relative to other markets that have had it, new construction costs what new construction costs. Jim doesn't have a big discount to us or Sand or whoever's building out there. It costs what it costs, and there's usually that first wave of tenants that recognize that it's not a price only business, and recognize that, this is new functional product and it serves a purpose for what they need. You don't usually have a discussion about 10, 12, 15, 20 cents, whatever it is, if there's a need. Sure, there's always that, hey, I'll make a lateral move and I'll upgrade if I can. But that's not really what these buildings now are being designed for. And relative to other surrounding markets, the rents in Las Vegas have definitely not kept pace with even Phoenix for Class A office. So there's no doubt in my mind, rates, they have to go up.
Well, Mike, I think, I'll close that out because this is always the calculus. We think of it, people misinterpret they undervalue the importance of the real estate, and they think the rent they're paying. And so the equivalent would be, at 5 per thousand, and you have 5 employees, presumably, let's just argue that fully loaded, make $100,000 between burden and everything. That's $500,000 your company is committed to 1,000 square feet in employees. So the equivalent is less than 10% of that is actually the rent. So the right question to be asking, for as it relates to rent, and more importantly, what the built environment is, what is the improvement in productivity to the $500,000 of employees that are working that space? Not did I save 5-10 cents on per square foot.
So let's switch it a little bit and talk about this kind of the same topic and how it impacts industrial. So if Jim, you're seeing $18 a square foot plus, which makes it difficult even to make office product pencil at higher rents. Rod, John, Reed, what does it mean for your development pipelines?
Reed, what does $18 mean to you in the Southwest?
Well, I could jump in on the Southwest, and we've decided to get in the game there, and a big challenge is actually assembling. What we've worked on is 7 parcels, 6 owners, so it's in a sense herding cats. So price is only part of the issue, but there's been so little of our type of product built over the past 10, 20 years. In the Southwest submarket, we believe there's a market there that will justify the prices that we felt were impossible just a short time ago.
Well, when I came out in 2014 and paid $9.50 a foot for the Post Road property between Jones and Rainbow, that was at that time the highest, I think, watermark for industrial space, industrial land post-recession. And now the site to the west of me, I think, is trading at 18, maybe even 20.
Right.
Is that you, Reed, buying it?
Not right there, but we are in the game over there, but not that site.
But vacancy, I haven't looked at the reports, but what's the mid-bay vacancy over there? 3? It's inconsequential. It's so low that it doesn't even matter to be quoted. So if you can get the product to work, you're gonna have plenty of demand. The problem that I think, or the things that get a little tricky, is when you're in the 90-cent range for a 5,000 or 6,000 square foot, 10 or 15% office finish out, space. That starts to far, far, far outpace any of our neighbors, right? And when rents have gone from 65 to 90 in 24 or 36 months for those small spaces, that's a lot of pressure.
Right, and those numbers are really specifically for the Southwest.
Yeah.
But really throughout the industrial market, throughout the valley, it's a question of scarcity right now. They're not building any more land. So what's left is what's left, and then we go further out.
The other thing to think about, Jeff, is when you're talking about the smaller mid bays, and a buck seems to be a big number on the surface, but keeping in mind you're over 5,000, 6,000 square feet, and even if it is 20 cents over what people are more comfortable paying, 20 cents on 5,000 feet, that's $1,000 a month, $12,000 a year in the context of what those small businesses are doing can be absorbed if they have a priority to be in that certain submarket, and if that's where their customer base is, or oftentimes just where people live, where their employees or the executives live.
Good point. I mean, it's the same. It's definitely worth the convenience of. I mean, it's not a massive difference of the financial obligation on the business.
What you will see, though, guys, is that North Las Vegas has been certainly the driver. If you look at the activity over the last 18 months, some of the stats, 90% of the activity was up in North Las Vegas. And you've seen that, over 24 months, actually it's very close to 36 months. What we saw is $4 dirt now going over $12 a square foot. You're starting to see that equilibrium. Finally, it's not as huge of a disparity. North Las Vegas is catching up. So you are going to see those rents continue to go up, looking at the new basis for these recent acquisitions. So it'll be interesting to see how it competes. Yeah.
So, we heard a couple times in the presentation, on this topic of land availability that the highest paying use determines the zoning, or that zone changes are too easy right now. Land availability is obviously a problem. And let's say we're successful in expanding the BLM disposal boundary. What should we be doing as an organization to ensure that master plans create adequate employment zoning? And how do we make sure that there is follow through and that plan is actually followed?
Well, we touched on it a bit. I think as a community, certainly NAIOP has spearheaded this effort for many years. I think the dialogue has to, it's incumbent for everyone to participate in that. I think, all the municipalities, we're finding different areas catering to different users. The North Las Vegas caters to a certain logistic tenant, a distribution tenant. I think we've got to, as a community, figure out, where some of those companies should go. What are some of the industries that are catering to some of those areas, and try to look at it as a larger community overall. Because I think what you're seeing is some competition, and that's not necessarily a good thing from a regional standpoint. I think that's one thing, and I think again continue to have NAIOP spearhead those discussions with the municipalities and the LVGEA, and I think obviously the chambers have to be part of that as well, because that messaging has to be consistent.
The other thing to think about is for how many years or decades, was it a chicken and egg question when it comes to industrial in Las Vegas? Why don't we have a 500,000 square foot, or why don't those users select Las Vegas? And the answer was there was no product. Now with the advent of e-commerce, I think the entire dynamic has changed. And now you see that product that accounts for I don't know if it's 90%, but the large amount of the absorption in Southern Nevada. And I think as a result of that, it's not that we're necessarily creating the opportunity for these companies to come here. It's that they've identified Las Vegas for what their demands are, for their distribution change. So for the longest time, Las Vegas has the stigma of being the one horse town, and we're going to cater to travel and tourism and be a gaming or hospitality trade show. That industry remains very damaged for the time being, and hopefully that'll come back soon. But at the same time, our market, particularly the industrial market, is as strong as ever, if not stronger. And I think we have to say that in many ways we've done a decent job of diversifying, better than we're probably given credit for when it comes to industrial. That's to say nothing of some of the other tech uses, which I think we have a long way to go. But with respect to industrial, we've done a nicer job of diversifying, and the release of lands, Marianna, I think is extremely important to that. It's extremely important down in Southern Nevada to have the available land to continue that diversification and the efforts there. Obviously, we've got the infrastructure questions and challenges, and we have the disposal challenges. And that's something else that I think we as NAIOP really do need to focus upon and figure out a way in which some of this land can be properly designated for the right types of development, and then just let the free market decide what's going to go where. And again, there's got to be, in my opinion, improvements on that process. Obviously, the federal government, that's taxpayer dollars, that's all of us. We want to see those, that income maximized, but at the same time, you have to have realistic numbers where developers and or owners can pay market prices to see the land taken down and put into production.
Hey, one thing, Rod, yeah, I was going to say, you hit the nail on the head. I mean, there has been an amazing, from a diversification standpoint over the last 24 months, some incredible stories. And what I find is that message is not getting out as widely as it is outside the community, and even internally. It's a bit of the media, that communication doesn't. I think it's more people want to hear outside some of the negative stories, and I think we have to push harder to make sure that collectively we're getting that message out for some of those wins that Southern Nevada has been getting. And I'm always having a lot of conversations on the outside, re-educating people that, hey, there's some very good things happening, not just maybe what's on the Strip going on, or in relation to the conventions and so forth, but there's some really positive things happening. So that's something that I think we can work on collectively as well to get that message out.
And coming up, there's going to be there's pent up demand, because when the resort corridor and these events come back, we've done so well diversifying, and then 9 months, 12 months, 2 years, whatever it is, there's going to be this whole piece of business that comes back here in some way, shape, or form. It might change, but I think there's some future pent up demand that we're going to be looking at that's going to really help catapult us forward.
I think too that, we need to have some dialogue with some of the municipalities in just discussing the importance of employment pods, because mostly what we've seen just historically going way back is the employment's been focused, on the Strip. There's been a few other offshoots here and there, but recently now we have all of the industrial diversification that's happening. And I think to Rod's point, it would be helpful to have designated areas that, I know we have it in North Las Vegas, but that's about it, where it is industrial zoned for employment. It makes for a balanced community. It makes for housing convenient to jobs, and it also will set an economic expectation, and the free market can determine what is ultimately paid for it. But certainly if the use is assured, I think that's a big step. And now's probably a good time to do it, because our number one industry is still impacted by COVID, and we're riding now the coattails of kind of the new economy here.
All right, guys.
Jeff, that you said, which I know I say all the time, all of us old timers do, industrial, it still kind of has a negative connotation in some people's minds. I think we need to focus more on, last mile delivery and things along those lines, rather than, the impressions of, smokestack development.
Yeah, I was actually involved in a project where an apartment developer has some surplus land, and he's like, now where would you keep all the hazardous chemicals here? So,
hey, all right, guys, I'm going to jump in here. We're running out of time, and I think Katrina is going to shoot me and Strickland too. But I have one other quick topic I want to cover. We're supposed to be done 1 minute ago, but I think this is important. So, Jeff, LaPour, you mentioned institutional capital coming into the market in the last, say, 5 years. Why did it take so long for institutional investors to realize that Vegas is a great place for their money? Why now, and what does that mean for our market going forward?
I guess if you start with what's available to buy, so from a scale standpoint, all of the institutional quality product here was historically in the hands of 3 groups. That would be Howard Hughes being primarily, whatever iteration of them it was. It would be Thomas and Mack, and it would be Rod's group, Majestic. So anything that had scale to it that was attractive to place large blocks of capital was never really being transacted. I think that's one of the first pieces of it. I think the second piece is that, to Reed's point, he's buying 7 parcels from 6 owners. Again, it's a question of scale. And then I think the third piece is that the market has been a very, very small market for a long, long time. When I first got into industrial real estate, in the early 90s, I think the size of the base here was at 19 million feet. And still, even at 150 or whatever we're at today, still a very small market. So I think those are the pieces that, kept folks out. And now that the buildings are larger, the tenant profile has changed. Blocks of Hughes portfolio has traded, Hughes Center, Hughes Airport Center, even the big Oak Tree Hines West Charleston office component. It's opened the door for the capital, and the profile and face of capital has changed dramatically too over the years. So it's not just to our market, but it's to every market, my opinion.
Mike, the influx of capital has kind of changed our strategy. We've transitioned from primarily growth through acquisitions to growth through development because it's so difficult to compete on the acquisition front because of that institutional dollars coming in.
I think the last point, not to keep it going too long, but secondary markets are becoming much more favorable around the country. I think we're seeing that that trend. Certainly, the pandemic has heightened that interest level. So going forward, the Las Vegas's, Reno's, Boise's, Tucson's are going to be much more attractive to a lifestyle that people want to work in. So I think that it bodes well, but I think you're seeing that trend now continue rapidly.
And capital's changed their profile. I mean, they're looking for yield, right? And you see big groups buying movie studios. I mean, they're just looking for yield, and where they can get it, they're going to get it. And when you see Blackstone buy Hughes Center, no better example than that in this market.
Awesome.
Okay, Mike, I was waiting, man. I was like, man, if I'm Mike, I'm not cutting this thing off either. That's fantastic, you guys. Thank you so much.
Thanks for having us.
Yeah, you're welcome.
Thank you, guys.
Thanks, guys. I really personally enjoyed it. It was great, and you guys were fantastic. Really appreciate it.
Thanks, everybody.
Jeff,
great year.
John, Reed, Jim, thank you. And feel free to take the survey and give us your feedback on that. Again, thanks to Mike and Compass Development. And we'll see you February 18th for the next breakfast. Thanks again. Be safe.
Thank you.
Bye-bye.